Welcome to the Fintech Times Presents series of webinars. Established in 2016, the Fintech Times is a global multimedia news outlet centered around the world's first leading fintech newspaper. We report on the latest and brightest ideas from the fintech world. And firstly, I'd like to say hello to our online audience. So hello. Today, we're looking at Regtech, the future of retirement and regulation, and follow the conversation using the hashtag Fintech Times Future of Regulation or on Twitter at the Fintech Times. For today's webinar, we're talking about developments in the regulation of pensions, lifetime ISAs, and the new digital ways of investing that mean the concept of retirement is now truly on the radar of younger people. With the acceleration of investment in the sector and global opportunities on the horizon, this panel will look to address trends across pensions, including ease of use, government legislation, and new regulation that could potentially help or perhaps hinder the market. And for today's discussion, we have a great group of people. I'd like to invite them onto the screen shortly. We've got Charles Delingpole, future CEO of Comply Advantage, the founder and CEO of Comply Advantage, Dan McLaughlin, Director of International at Smart, and Emma Douglas, Head of DC at Legal & General Investment Management. So welcome everyone. Thank you for joining me on screen. I'm going to start off by asking you to give a short introduction. So good morning, Charles. Do you want to start us off?
It's fantastic to be here, Gina. Thanks for the introduction. So I'm the founder and CEO of Comply Advantage. We are, to your point, a Regtech company. So we have the world's best, largest database of terrorists, money launderers, human traffickers, criminals, people, companies. And so we help companies avoid doing business with terrorists and money launderers.
Perfect. And Dan, do you want to introduce yourself?
Yeah, sure. Again, thanks for the invite. Hello to everybody. So, I'm Dan McLaughlin, so Director of International at Smart, as you said, and I kind of look for or identify and devise our entry into new markets around the world, and of which there are many, and we're moving into quite a few, pretty good order. So what we do at Smart, we've built and deployed our own retirement technology platform, and it's used as a platform as a service by financial institutions, banks, insurers, pension funds, etc., to run and manage their pensions businesses.
Excellent. And Emma, do you want to introduce yourself?
Yeah, hi, I'm Emma Douglas. So I'm the head of DC at Legal & General Investment Management. So we're kind of a big contrast, I suppose, to Charles and Dan. So, this is a big insurance company with massive amount of pension assets. So I sit on top of 114 billion of pension assets, 4 million members. So we're a bit of a super tanker when it comes to DC.
And it's great to have you on the webinar. So thank you for joining us. One of the questions I think that we'll be asking shortly, and I want to say to anyone watching, please do feel free to send in any questions to the chat and we'll address those later on. But I think maybe we should start with how the future of fintech adoption is driving those sort of pension technologies, especially among the younger generations anyway. Emma, would you agree that younger generations are more likely to be looking at pensions now and technology plays a part in that?
Yeah, I would actually, Gina. I mean, and if you'd asked me this probably a couple of years ago, I wouldn't have said that. I'd said that, engagement is really low. Auto enrollment is brilliant because it gets people into a pension, but necessarily we're using the forces of inertia and apathy to keep them in there. And that in itself doesn't generate engagement. But I do think now, particularly we've seen around things like ESG issues, members are getting quite fired up about what they can do. And we've worked with fintech platform Tomelo, so members can actually indicate how they would vote on key issues at the companies that they hold. And that's really engaged the younger demographic. We've actually had most engagement and most votes from the 25 to 34-year-olds. And those are traditionally the segment, and it's so hard to get engaged in pensions. So yeah, we've actually seen real live examples of this.
That's really interesting. And I think, Dan, we were just saying before this went live that although there's young people involved, you're finding it slightly more the middle age group that are involved at the moment, would you say?
Yeah, I think it's, people start to really worry about their pensions and retirement and how much they're going to have to spend. Can you still go on holiday when you probably in your mid 40s. Wake up packs are probably about 10 years after that, and from the regulation. But just what Emma was saying there, definitely echo some of those points. I think purpose-driven and belief-driven investments, as Emma referred to, but just that's going to really drive people's motivations for engaging with any service, really, especially a digital service. But I think in terms of adoption and young people, again, I think it cuts across all age cohorts, is you've got to make the experience, the digital experience, what people expect these days. And there are lots of fantastic technology companies around the world doing wonderful things in all different, and we use them every day. So why not the same in pensions and retirement? And typically that's not been the case. And I think that's where how we see the world is making sure how easy something is to use, how enjoyable it is to use. And if you want to make a decision, do something, find something, then that's really easy and in line with your kind of general expectations. That's kind of how I'd see, especially for young people, but generally, yeah, across all age cohorts, I reckon.
And Charles, when it comes to the attitudes and the concerns of regulation behind the technology as well, do you think there's kind of a big gap in the people who are using this technology and certainly looking for more user interaction, and how does that work in the regulatory sense?
So I guess in terms of the overall landscape, in terms of technology and regulation, I'd say there's been a kind of explosion of different companies like Smart Pension who are aiming to service this, as in now that companies can go direct to the end users. I think there's the Pension B ostensible IPO coming up. I think there you got a company with kind of roughly 7 million revenue looking for like a 400 million valuation. And then I'm not sure about the overall size of Smart Pension or all the kind of structural factors, but like I think what you've seen is a huge surge in interest in these companies. In terms of the FCA, PRA, I think what you saw like in the 1980s was people like Robert Maxwell who stole the entirety of the pension funds of the employees of Mirror Group, right? And then you saw, I guess in terms of the broader intergenerational conflict between millennials who, unlike their parents, haven't been given massive defined benefit contributions. They have to suffer with tiny defined contribution. And so I guess structurally, there needs to be a huge surge in investment. And therefore you've seen companies like Smart Pension come in 3 years ago, which means that companies now have to set aside a certain portion for everyone rather than, and so it's opt out rather than opt in. So I think that's a much better situation than having like thieves like Robert Maxwell steal people's retirement money.
Always good not to have thieves when it comes to losing money, definitely. Emma, you mentioned earlier as well about auto enrollments and some of the changes that have come in there. What about conversations on ISAs and stocks and shares and ease of access, I think, for users? How do you think that's helped?
Yeah, I mean, my world, Gina, is very much the world of pensions. So, you know, auto enrollment has absolutely transformed that world, you know, and now we've got up to 8%. You know, that's great because people are putting their money into a pension. So, you know, that kind of addresses some of Charles's points that he was making. Now, I do think we could really do with that amount being higher for most people. But I think what COVID has shown us is that there was so many people who didn't have any savings to fall back on. So, you know, you might have been made redundant, the washing machine breaks down, your car breaks down, that there's no other savings, you have to get into debt. You know, that's a really horrible cycle. So I think that's why we've seen a lot of discussion around things like sidecar savings, you know, and that could be into an ISA alongside a pension, but trying to get people into that savings habit, but giving them some money that they can access in the short term if they need to. We've had quite a lot of people who've been made redundant, you know, who are members of our pension schemes, call our helpline and they really want to get their money out. But of course they can't unless they're over 55. So, you know, I'm certainly in favour of some kind of safety net for people. And I think you can get that through regular savings into an ISA. So, you know, ISA and pension, I think, can sit alongside each other. But sometimes you've got the issue of, you know, people actually haven't got that much spare money. So where do you put it? And auto enrollment tells you you're putting it into a pension rather than short-term savings. But we know people need both. It's just in this time of crisis, it's been quite horrible seeing how people haven't got the short-term savings to fall back on.
Absolutely. It's been quite an amazing 12 months in all sorts of ways for different people. But in terms of the regulatory changes, Dan, maybe you can answer this one. What's been driving the pension sector forward in recent years?
I think the biggest driver has got to be the size of the challenge, the ever-growing problem. I mean, the world's getting older, there's more people, government public finances are getting worse to pay for people's retirement, and you do actually see a massive retirement gap emerging in terms of trillions of dollars around the world, i.e. what we need in the system so people can have dignified retirement. So what you're seeing as a trend now is a number of reforms, and I think only through regulation can you solve that global problem I've just set out. And obviously fintechs, regtechs, we love regulation no matter how complicated it is, so bring it on. But in terms of what you're seeing as the model, you're seeing as DC now is the dominant model, so defined contribution. So you pay in and it's invested, and you've got an account essentially, different to historically our parents, etc., having defined benefits. So we're seeing that very much as the dominant model now. I think that's without question. And what Emma referred to it, auto-enrollment, you've seen a lot of uniformity in the reforms, lots of countries starting to learn from each other, because I think sometimes you have a purely voluntary system in pensions. It can work, but it depends on a few other factors. So you've seen auto-enrollment across the world, and it's not inconceivable in about a decade to have 1 billion citizens around the world who have been auto-enrolled into a company pension. So I think they're the big drivers. There's a whole raft of stuff underneath it. I mean, Emma touched on short-term lending in the UK. You can't access your pension early, and I'm not advocating early access to a pension because there's lots of pitfalls to that, but in other countries you can, as a matter of course. In France you can, in America you can, in Australia you couldn't, but they brought something in for COVID. So it does exist, but there's definitely pros and cons to that. But the big drivers, I would say, do point towards reforms like auto-enrollment.
And that's interesting. And I think, sometimes we, in this country, we don't always know what's happening in other countries as well. So touching on that is fascinating, I think. And in terms of sort of user experience, Charles, what do you think is changing, and where do you think the sector will go?
I think kind of similar to open banking, you've seen this kind of explosion in different companies that have offered different services. I think the kind of land grab that you had about 4 years ago with companies like Smart Pension, signing up thousands of companies. I think there are some companies launching now around the ability to help self-employed companies and small businesses. But I think the kind of same explosion of innovation you saw 4 years ago probably won't be repeated. I think what you've seen is kind of is in the same way that the UK was a leader in things like opening up neobanking in 2009, as in we moved from 4 major UK banks to having this huge wave of fintech. That model is now being exported overseas. So I think I first met Dan in Prague in 2016 because I think Smart Pension and others were lobbying others to adopt this same mechanism. So I guess the UK, in terms of being a regulatory innovator, can then export its practices, which also helps the extent to which the companies that have had a foothold in the UK can then offer those same services to countries overseas. So I think the future is, to the question about being forced into a pension, I think the future is automatically being enrolled into defined contribution pensions, and that model will be adopted overseas, and the companies and technology platforms that have innovated in the UK will then be leaders internationally.
Great, thank you very much. And Emma, talking about defined contributions, just like to bring you in. You mentioned COVID earlier as well, and I was wondering on the user experience and the tech side, whether there had been any kind of conversations about implementing new technologies to serve any customer requests, or the dashboard differences, COVID help desks. How have you kind of tackled that with technology?
Yeah, I think COVID, has been an accelerator of a lot of, use of technology. So, what we've seen is that not everybody in the past really wanted to deal with us online or, use the digital services that were there. But COVID, we've definitely seen a huge uptick in the number of people who are actually willing to engage online, to go in and look at their account balance, to do some modeling, to, view things like our video benefit statements that just have a nice sort of 2-minute picture of this is what you could get. This is what you could get if you paid in a little bit more. Here's the button to click, go do it now. So we've seen much more use and adoption of digital technology. Also, people used to phone us a lot. So, it's like, the help desk is a very big part of a service that we offer. But increasingly now, more people are willing to web chat, to go to a chat bot, to get FAQs. So I think that gradually we're seeing much more user adoption of some of the technologies that, to be honest, have been there for a while, but people have kind of been more used to I'm going to pick up the phone, or I'm going to write to this pension company. Now we are seeing them being much more willing to engage digitally. And I mean, I think that's great all round, because then that, reduces the overall costs of servicing. That's got to be beneficial when fed into the price that people are paying for their pensions. So I think it's a win-win that has definitely been accelerated by COVID.
I think so. And Dan, you're at the forefront of that field as well in terms of the tech. How have you found the last 12 months, and have there been any kind of implementations with Smart in terms of technology and focused on the pandemic, for instance?
So yeah, in terms of it's almost like it's impossible not to talk about COVID. There'll come a day where you're not allowed to mention it in any meeting. It'll be like Brexit. But seriously, yeah, it's obviously a massive challenge for a lot of people. I think what we've seen is a greater adoption of what we do and a greater demand for what we do and how we go about it. There's obviously been some shocks to existing business models where you've suddenly got to send everybody home or provide lots of information to people in short order. Because what do you do when people panic or in a survival mode? You dig out those bits of paper that you rammed in that box or whatever. And it's important that people are able to, like Emma was saying, just press a button and see what's theirs and what they can actually do with that. So in terms of demand, yeah, kind of strategic level, it's definitely gone up the prior to listing boardrooms. We went live actually in 2 markets during COVID, in Ireland with the Bank of Ireland and Zurich in the Middle East. There's some big reforms there to do with savings, to do with international workers. So you got to be careful with your words, but I mean it's positive because basically what it means, the penny dropped more often now in terms of the need to adopt technology, and it's linking to the Khalifa review where one of the kind of mantras was fintech is mainstream. I think it's helped with that, really come to the surface. It's not a niche over there, not a trend. It's just pretty normal and a sound option if you're looking at digital transformation or other bits and pieces.
I've just had a quick look at the chat box, and it looks like we're getting some questions in. So maybe if we do one more question, and then we'll take some questions from the audience. Where do you see kind of the future of regulation going in the pension sector? And what does the landscape look like over the next few years, do you think? Charles, do you want to start with that?
Sure. Yeah, I mean, I think there's 2 answers to that. Firstly, in terms of the current, it's fairly easy to argue that the fundamental social cleavage today isn't one of gender, ethnicity, or race. It's probably age. In terms of what you've seen in the past year is trillions of dollars of funds being allocated, and then the vaccine drive, which is primarily to protect the kind of the older members of society who themselves have benefited from defined benefit contributions, from huge numbers of assets being inflated in the past 50 years, from much higher house prices. And you've seen the younger generation have been victims of that, and they haven't had the same career opportunities and probably will be far poorer and far less well off than their parents. And there's no fundamental reallocation of resources. And therefore what you see is the radicalization of these millennials, right? So I think that's the real issue, I think. In terms of regulation, it's kind of probably more around fraud than about equitable allocation of resources, to the extent that many pensioners who've redeemed a portion of their pension pot have then been defrauded and therefore being left destitute. So in terms of the first question around being forced into a pension, I think many people I know are like terrible with money and fairly soon are destitute because they can't manage anything and then come like asking for help. So I think like fundamentally you have to protect people from themselves because often they're incapable of managing their own affairs.
That's it. That's a very good point to make. And Emma, we'll pick up on that question in a moment, but just going back to sort of where you see the future of regulation in retirement going over the next few years.
Sure. Yeah. I mean, auto enrollment, and that is forcing people into a pension. It has been a huge policy success. There's 10 million more people saving for their retirement. And as Charles said, they're going to need this money at some point. That at some point you won't get any salary, so you're going to need money from a pension. So it's really, really important that people do save for their retirement. And auto enrollment has been a brilliant way that that's happened. So what I'd really like to see, and the minister did hint this at PLSA conference recently, that some of the reforms that have been suggested by the 2017 review to auto enrollment, to make it broader, to make it deeper. So you start contributions from 18 instead of 22. Those early years can make quite a big difference. To spread it out so that auto enrollment starts from the first pound you earn rather than these earnings bands. And that will actually bring so many more part-time workers and women into auto enrollment. And, I really worry about the gender pensions gap, very much linked to the gender pay gap, of course, but, the gender pensions gap is a worry in its own right. So these reforms, as recommended in 2017, they might not get enacted, as the minister said, until the mid-2020s, but they would make a massive difference to how many more people are actually saving for their
student
retirement.
loans, basically. So you have double whammy for any 18-year-old paying huge amounts of student loans, having a tiny salary, but then also paying to their pension as well. So you can see how people who are kind of at least post-university getting absolutely hammered.
You can, Charles. And then what I would suggest at that point is not to sort of throw the policy away, but to maybe give some opt-down options. Most people could afford 1% of their salary going in, their employer will match that, so maybe it's not the full 8% to start off with. I think that's a perfectly reasonable thing to ask. And also, people might want to spend money on other things rather than long-term savings, let's face it. But wouldn't it be great to get them in to start that savings habit, even if you start it really, really small? And those early years, they really do add up over time. That there is a massive power there of compounding, that it would be great to start that little bit earlier for people. But I think this is where opt-down options, so you don't have to pay the full amount, or these sidecar savings options that you start out by saving into an ISA, then you can move that into a pension, but you're not locking it away immediately. That there's ways that we can look at this to make the policy work for the practicalities of the people that we're looking at. But I think generally people would feel better knowing that there was some savings going in there and they didn't have to think about it too much. So it's probably the level, I think, that we need to address rather than not doing it for the younger generation. At the other end of the spectrum, I really think we need far more rules and regulations around the post-retirement world as well. Now we've got freedom and choice. You don't have to buy an annuity. Someone described it to me as a maze full of sharks. Really difficult to work out. Lots of people trying to rip you off. So the more we can regulate around that to make that a safer place for people post-retirement, I think that's really important too.
Maze of sharks. I'm going to remember that one. Quite a good analogy. Dan, would you like to add anything to that at all?
Yeah, I definitely echo auto enrollment being a great policy intervention, a great tool for governments around the world. That's for sure. I think on the gender pensions gap, I think that exists in lots of different countries, and so it does feel like a contender for some form of government intervention to try and level up that, because it's proven to be massively unfair. So that's I imagine that being on the policy table for discussion in the years ahead. I think, as I referred to before, I think purpose and belief driven regulations, we're seeing that now in the UK. I think that's going to be very, very strong, but I think just general populations will expect that. And I agree with Emma. I think one of the big things is retirement income, because in a defined contribution system, unlike a defined benefit where you guaranteed your final salary pension, you know, that system does delegate almost all responsibility to the individual, hence maze of sharks swimming around. So retirement income is definitely going to be a priority. And that's what we're also focused on at Smart. And you see that being a huge topic in Australia right now, really kind of almost on the top 3 issues in the pension fund boardrooms at the moment.
And I see there's one more question. Are pensions affected by generational and cultural differences? And in terms of regulations, the setup for older generations, does it favour the older rather than the younger generations? Charles, do you want to start us off with that?
Yeah, I think the key dimension of that is the regulations are set up to prevent people from entering into Emma's maze of sharks, to the extent that people are subject to pressures and they're incapable of often preparing themselves for their retirement, and therefore they need to be protected both from the sharks and themselves. In terms of the generational and cultural differences, I think to the earlier point around today's graduates having the triple whammy of massive student loans, huge house prices, and very meager pensions, the allocation of resources to today's younger people is like extremely poor, and those are amplified by existing gender differences in terms of the asymmetry of pay between different sexes, and government policy towards overrepresented roles like nursing, which would favor one gender over another. So yeah, I think that although explicitly the cultural and gender differences aren't marked out in the policy, they are amplified by the underlying structural forces. So I think if you simply ignore the differences, then you amplify existing social tensions and cleavages.
I was on mute there, sorry, Charles. Very interesting. And Emma, do you think that's exacerbated by generational differences at the minute as well?
I mean, clearly that there are generational differences in society, and you know what we're seeing at the moment is that, you know, the generation retiring now, you know, the boomers and the older generation Xers, you know, these are the ones that have lucked out in life's lottery. You know, that they've generally got DB pensions, which is, you know, your guaranteed income. Yeah, at least at a household level, they probably have that. You know, they've also potentially got some housing wealth. Then, you know, you move down into the Xers and millennials, you know, then you've got far less of that. So you've got less certainty about your pension income, and you've got potentially no housing wealth. You might need to pay rent right through into retirement. So you've got extra costs there as well. So I think that there's definitely intergenerational inequality. However, I think that pension policy is trying to be as kind of blind to that as it can be. You know, most active members now, most employees will have a defined contribution pension. You know, there's very few will have DB pensions, an open DB scheme. The older ones might have some from their past employment, but most people today are in DC. So I think absolutely our mantra should be to make defined contribution pensions as good as they can be, because these will be the pensions that the future generation will be relying on for their income in retirement. They don't come with all of the gold plating of DB, but it's up to us to make sure that people are paying in enough money into funds that invest in things that people really can get behind and align to, that are aligned with their values. And that way, I think we'll get slightly more engagement around what this pot of money is, what it's actually doing in society, and what it's actually for, which is to provide that income in retirement.
It's interesting. I've just had some questions come in thick and fast in the last couple of minutes, and And one of the things somebody wants to know is about ESG, and is that an increasing factor when millennials are thinking about their pensions? Dan, what do you think about that?
100%. Yeah, I think, speaking from a small sample size of my own family, it's interesting that without even, talking to, the kids, that their view of the world is completely different. I remember being on holiday when we were in Spain and at a bar, and my daughter, she was 6 at the time, she's pulling my shirt saying, Dad, I said, what's the problem? And she says, they've got plastic straws on the bar. As if it was this like not wearing your seatbelt kind of moment, or smoking in a pub. So I think the world, it started, but there's a tidal wave of different opinions and mindsets that's coming. But in terms of the here and now, yeah, it's real now. And I think it's certainly an issue for young people, but definitely broader than that. And, the government's obviously serious about this as well. And so is the minister. And you see it in other countries as well, where they provide, Netherlands and New Zealand seem pretty good at this in terms of providing real transparency on what you invest in and what the impact of it, giving things scores. And at Smart, we're also thinking about the very similar things in terms of, incorporating belief systems into the experience and also the investment side of things. So I would say it's core and just going to get bigger and bigger until it's completely the norm.
Absolutely. And Charles, maybe one for you about the gig economy workforce, and does it lend itself to traditional pension contributions, or is saving with the likes of Monzo, Starling to round up more suited to flexibility?
Yeah, I guess the different areas of regulation we touched on have been threefold. Firstly, the kind of harvesting side, which is what Dan generally deals with. Then the disbursement side in terms of, do you enter into the maze of sharks by redeeming a portion of your fund? But then also there's the asset management side in terms of where that money, once harvested, is invested. So by Vantage, we have raised $100 million mainly from ultimately pension funds. So we have 2 VCs whose LPs mainly are pension funds, and then our Series C was from the Ontario Teachers Pension Plan. So in terms of where all the money's going, ultimately it's going into companies like Vantage, right? And therefore, it's my job to generate a return of the $100 million for the pensioners and teachers in Canada, basically. As in, if I do a bad job, then teachers in Canada will get kind of a very bad retirement, right? So, and I think in terms of the questions around ESG and the gig economy workforce, so I think we saw that last week, specifically Uber, of the 3 classifications for workers in the UK, you have employees, workers, and freelancers. And therefore, now by being classified as workers, the gig economy workers of Uber, but not yet Deliveroo, will have auto enrollment pensions available to them. I think specifically with regards to the question of is the Monzo Starling Bank roundup feature good enough, right? Like, I think no, it's not, right? Because if you look at like how you're going to save your retirement, right, you're going to need an annuity with a yield of at least like 20-30 grand minimum, right? And if you're saving pennies, right, and like you then need to invest that in a kind of ETF or a fund, or like you need to have that compounding at 20%. And the reason why Emma was keen on 18-year-olds investing is because the duration of that is critical to the return profile, right? So I think like the roundup feature, unless it's going into something which can generate returns, like the funds who invested in our Series A are going to make like already 30 times their money, right? Like, and they can only afford to do that because the 10 other investments they make will kind of die and fail, right? So fundamentally, Emma and Dan need to put their money they're harvesting in projects that can return tons of money, right? So on the ESG question, I'm an investor in a company called Silvera, and what they're doing is they're using LiDAR and satellite data to map ESG projects to do with carbon offsets, and therefore you can tell which asset classes are which specific projects are generating ESG liable returns, and therefore in terms of like where the money from Monzo starting round, that has to go into funds managed by Emma and allocated to by Dan, but also into projects which can help fundamentally improve the world 20 years hence, because all the pension money is going into companies and projects, and unless we actually build the future and build companies which can generate returns, then that, like, you have to remove the kind of alienated shroud of like mystery. Like fundamentally your money is going to companies that will pay dividends, right? And unless you have those companies being built, then there won't be any pensions.
That's an excellent point. And just thinking about doing maybe a quick fire one to end with, but what would you say we should kind of need to look out for when we're watching the retirement sector over the next few years? Is it regulation? Is it improvements in technology? Or is it more education to the workforce? What would you say, Emma?
Wow, that's a tough one, Gina, because it's all of those things. I mean, we still need a lot in the pension sector. So, I think we absolutely are going to see more regulation, more frameworks post-retirement. So the FCA have started that with their investment pathways. I think there's still quite a long way to go on that form of regulation. And I think also, we need to think about the money going into the system. So that's, increasing the amount paid in by auto-enrollment with some opt-down features as well for those that can't afford it. And then also looking at where that money's invested. So, thinking of some of the stuff that Charles and Dan have talked about, where are you putting this money? And it has to be aligned with where members think you should be putting that money. And we're increasingly getting so much better data on that. So when we use the Tomello platform, people vote on issues that the companies that are held in their portfolio, come up with. So, use of plastics, definitely one, Dan, transparency of disclosure, gender, race on boards, all of these kind of things. From that, you get some massively rich data of what people actually care about. And then you can build those into your portfolios and actually have something that is a representative portfolio of what, the nation, or at least your pension savers, really think about investment. So I think there's some fantastic things that are out there enabled by fintech. We haven't even talked about the pension dashboard as well. For me, that's such a massive one, because being able to see all your pensions in one place, be reunited with your lost pensions, all of this is going to be so vital, because I do think it's quite sad now, because when people do go online, they might use a pension projection tool. They're probably only using it for their current employment. And, with 11 jobs on average in your working lifetime, that's 11 different pots all over the place. Seeing those together, getting a holistic picture of your wealth is just going to be so powerful going forward. So yeah, so much to come, I think.
And Charles, what about for you? Is it education, is it regulation, or is it technology that we need to be looking out for?
I'd say regulation in the form of state intervention, because of the paucity of investment and the lack of planning in terms of the kind of the kind of fundamental structural demographic shifts in terms of declining birth rates or economic growth and the liabilities. And therefore, I think fundamentally there have to be some sort of state intervention whereby the level of debt in terms of borrowing, like I just wanted to what extent the overall numbers add up for pension allocation for the next few years.
And Dan, finally, what do you think should be on the horizon? Is it technology, is it regulation, or is it education?
I would almost similar things to what Emma was saying, to be honest. I think all those, just to pick on some bits, I think the pension dashboard would be interested in the UK, through technology APIs, if it was very easy for anybody in this country to see all their pensions and then make better choices by saying, Christ, I didn't know I was paying that much on that. You've got, for some of them, you've got a Mars bar, you're paying 20p and 80p for the same kind of thing in two different shops. You'd probably think differently about that, wouldn't you? So I think that'll be a really big thing. But that does exist too, and the infrastructure does exist in Australia for that. You can, when you do your tax return, you're asked to kind of combine your superannuation accounts. But lots of people don't. Even then, there's lots of extra accounts because they still perceive it as being really difficult. So I think that's where technology, kind of the overlay and making something really, really easy and getting rid of that complexity, you know, the Regtech aspect, the process in the background, and just to show what you need and allow the user to do what they need to do is going to be key. But something like the pension dashboard with those kind of great outcomes that could deliver for people would be an interesting area if we could get that going.
It's always the way, isn't it? We need it to work. We need it sooner than I think what's in the pipeline. But I'd like to thank you all for joining me today. I think it's been a brilliant webinar, and you'll be able to catch it on record shortly on the Fintech Times website. So Charles, Dan and Emma, thank you ever so much for joining us as we covered Regtech and the future of retirement. Thank you.